Imagine waking up on an ordinary Tuesday morning. You grab your phone, open your banking app, and tap your checking account like you've done hundreds of times before. Instead of seeing your balance, a message appears. Your account has been restricted. At first, you assume it's a glitch. You close the app, open it again. Same message. You try using your debit card to buy a cup of coffee. Transaction declined. You head to the nearest ATM. Nothing. You call customer support, expecting a quick explanation. Instead, you hear words that instantly change your entire day. Your account is currently under review. We can't provide additional details at this time. Please wait for further communication. No timeline, no explanation, no access to your money. Your paycheck was deposited yesterday. Your rent is due tomorrow. Your credit card payment is scheduled for the weekend. But suddenly, the money you've spent years earning feels completely out of reach. It sounds like something from a movie. Yet situations like this happen more often than most people realize. Every year, thousands of bank accounts around the world are frozen, restricted, or permanently closed. Sometimes it's because of fraud. Sometimes it's because of identity theft. Sometimes it's a simple misunderstanding. And in many cases, customers never see it coming. Here's what surprises most people. Banks don't actually need to prove you've committed a crime before restricting your account. In many situations, they only need to believe that something unusual has happened. That single detail changes everything. Because modern banks aren't just places where we store money anymore. They're also financial security checkpoints. Every transfer, every deposit, every withdrawal, every international payment, every online purchase leaves behind a digital trail. Most of those transactions happen without anyone paying much attention, but occasionally, one transaction triggers an alert, then another. Before long, automated monitoring systems begin asking questions long before a human investigator ever looks at your account. That's because today's banks process millions of transactions every single day. No employee could manually review all of them. Instead, sophisticated computer systems constantly search for patterns that might suggest fraud, money laundering, stolen identities, or other suspicious activity. The overwhelming majority of customers never notice these systems working. But if your account gets flagged, you suddenly become very aware they exist. The difficult part is that being flagged doesn't automatically mean you've done something wrong. Sometimes people are victims of identity theft. Sometimes they unknowingly receive money connected to fraudulent activity. Sometimes a perfectly legitimate transaction simply looks unusual compared to their normal banking habits. Imagine someone who usually spends a few $100s each week. Then one afternoon, they suddenly receive a transfer for $20,000 from another country. Even if that money is completely legitimate, the bank's monitoring system may still pause the transaction until it can verify what's happening. From the bank's perspective, that's not punishment, it's protection. But from the customer's perspective, it can feel like their financial life has been turned upside down overnight. And that's exactly why this topic matters. Because understanding how banks make these decisions isn't just useful for finance professionals. It's becoming essential for anyone who relies on digital banking, which today means almost all of us. Over the next few minutes, we'll answer some important questions. Can a bank legally close your account without warning? What actually happens behind the scenes when an account is flagged? Why do perfectly innocent people sometimes find themselves locked out of their own money? And perhaps most importantly, what can you do to reduce the chances of it ever happening to you? The answers reveal a hidden side of modern banking that most people never think about. Until the day they have no choice. If you've never had your bank account restricted, it's easy to assume it only happens to criminals. After all, if you're honest with your money, why would the bank ever have a problem with you? The reality is much more complicated. Banks don't wait until they're certain a crime has been committed. Their job is to identify potential risks before serious damage occurs. Think of it like airport security. Most travelers aren't dangerous, But security officers still screen every passenger because it's impossible to know who might pose a risk until they look more closely. Banks operate in much the same way. Every day, they process millions of payments, deposits, and transfers. Some are completely routine, others aren't. When a transaction falls outside what's considered normal, automated monitoring systems may flag it for review. That doesn't automatically mean you've done something wrong. It simply means your account no longer fits the pattern the system expected. Imagine someone who normally spends $500 a month using a debit card. Then suddenly, within a few hours, thousands of dollars begin moving through the account. Several transfers arrive from unfamiliar people. Large payments are immediately sent somewhere else. To the customer, there may be a perfectly reasonable explanation. Perhaps they sold a car. Maybe they're helping a family member purchase a house. Or they're running a small business that's suddenly having a busy month. But the computer doesn't know any of that. It only sees unusual activity. Its job isn't to determine guilt. Its job is to slow things down until someone can verify what's happening. This is where many people become frustrated. From their perspective, it's their money. They earned it. They paid taxes on it. Why should anyone stop them from using it? The answer lies in the responsibilities banks have behind the scenes. Modern banks operate under strict financial regulations. They are required to monitor accounts for signs of fraud, identity theft, money laundering, terrorist financing, and other illegal activity. If regulators later discover that a bank ignored suspicious transactions, the consequences can be enormous. Banks have paid billions of dollars in fines over the years for failing to maintain effective compliance systems. Because of that, financial institutions often choose to investigate first and ask questions later. It's not always convenient for customers. But from the bank's perspective, allowing suspicious transactions to continue unchecked can create far greater risks. Another common misunderstanding is that only large transactions trigger reviews. That's not always true. Sometimes it's the pattern rather than the amount. For example, dozens of small deposits arriving from different sources within a short period can attract just as much attention as one unusually large transfer. Likewise, repeatedly moving money into an account and sending it back out almost immediately may appear unusual, even if every payment has a legitimate explanation. Again, context matters. Unfortunately, computers don't automatically understand context. They recognize patterns, and when those patterns resemble known forms of financial crime, they generate alerts for further investigation. In recent years, banks have invested heavily in artificial intelligence and advanced monitoring software. These systems analyze far more than individual transactions. They compare spending habits, login locations, device information, account history, and thousands of other data points that most customers never realize are being evaluated. This technology has prevented countless cases of fraud. But it also creates situations where completely innocent customers are temporarily caught in the system. That's one reason customer service representatives often seem unable to explain exactly what's happening. Many investigations are handled by specialized departments. Frontline employees may see that an account is under review, but have little authority to change the decision or disclose additional details. To the customer, it feels like nobody is listening. To the bank, the investigation is simply following internal procedures. And while those procedures can be frustrating, they're only one part of a much larger system designed to protect both the financial institution and its customers. The surprising part is that account reviews aren't always caused by suspicious transactions alone. Sometimes the reason has nothing to do with the money moving through the account. Does this transaction match their usual spending habits? Has this account suddenly changed its behavior? If the answer is yes, the payment moves through without anyone noticing. If the answer is no, the system creates an alert. That alert doesn't automatically freeze your account. Instead, it tells investigators, take a closer look. Sometimes everything checks out within minutes. Other times, the review becomes much more complicated. Imagine someone who has spent years living in one city. Suddenly, their online banking account is accessed from another country. Within an hour, several expensive purchases appear. To the customer, this could be a vacation, or perhaps they're traveling for work. But to the bank, it could also look exactly like a stolen account. Rather than allowing thousands of dollars to disappear, the safest decision may be to temporarily block the account until the customer's identity can be confirmed. Ironically, the same security measures that frustrate customers often save them from losing their life savings. The challenge is that computers can't understand every situation. They don't know whether you're buying a wedding ring, paying university tuition overseas, or helping a relative during an emergency. They simply recognize that something is different. That's why banks sometimes contact customers asking seemingly strange questions. Did you authorize this payment? Can you explain this transfer? Can you provide documentation showing where these funds came from? To many people, those questions feel intrusive. But from the bank's perspective, they're part of proving that legitimate money is moving for legitimate reasons. Another factor many people overlook is identity verification. Opening a bank account used to require little more than walking into a branch with a few documents. Today, the process is much more demanding. Banks must verify identities, confirm addresses, screen customers against government watch lists, and continuously update customer information. If important identification documents expire, if personal information no longer matches official records, or if the bank can't verify required details, certain account services may be temporarily restricted until everything is updated. Again, it's rarely personal. It's simply part of operating within increasingly strict financial regulations. There's another misconception worth clearing up. Many people believe that keeping cash in the bank means they have complete control over it at all times. In reality, banks have both contractual agreements with customers and legal obligations to regulators. Those responsibilities sometimes require them to delay transactions, request additional information, or even close customer relationships altogether if they believe the risk has become too high. That doesn't mean banks are trying to take people's money. In most situations, customers eventually regain access to legitimate funds after the review process is complete. But the experience often leaves them asking the same question: could this happen again? The honest answer is yes. Not because the system is broken, but because modern banking has changed. Banks are no longer judged only by how well they protect deposits. They're also judged by how effectively they prevent financial crime before it happens. That responsibility has transformed the relationship between customers and financial institutions in ways most people never see. And perhaps the biggest surprise of all, sometimes banks don't just freeze an account. Sometimes they decide they no longer want the customer at all. And when that happens, the consequences can be far more disruptive than most people imagine. For most people, a frozen account is stressful, but eventually the review ends. The bank verifies the information, removes the restriction, and life returns to normal. Sometimes, however, that isn't what happens. Instead, the customer receives a short email or letter. After reviewing your account, we've decided to end our banking relationship. No detailed explanation, no lengthy discussion, just a notice informing you that your account will be closed and that you'll need to move your money elsewhere. For many people, this comes as a complete shock. Can a bank really do that? In many cases, yes. When you open a bank account, you're entering into a business relationship. Just as a customer can choose to leave a bank can also choose to stop doing business with a customer, provided it follows applicable laws and the terms of the account agreement. That doesn't necessarily mean the customer committed a crime. Sometimes the bank decides the account requires more monitoring than it's willing to provide. Sometimes repeated unusual activity creates too much risk. Sometimes documentation can't be verified. And sometimes the bank simply believes another financial institution may be a better fit. Unfortunately, banks often provide very little information about why an account is being closed. That lack of transparency frustrates many customers. But there's a reason. If banks explained every detail behind their fraud detection systems, criminals could learn exactly how to avoid them. Keeping certain procedures confidential makes those systems more effective. Imagine relying on one account for everything. Your salary is deposited there. Your mortgage payment comes from it. Your utility bills are automatically deducted. Your investment accounts are linked to it. Then, almost overnight, you have to redirect your paycheck. Update every automatic payment. Transfer your savings. Notify employers, family members, and service providers. Something that looks like a simple account closure quickly becomes weeks of paperwork and disruption. That's why financial experts often recommend avoiding complete dependence on a single bank. Having a backup checking account or emergency savings at another institution isn't about expecting disaster. If one account becomes temporarily unavailable, your financial life doesn't come to a complete stop. Another good habit is keeping your personal information up to date. If your address changes, update it. If your identification expires, renew it promptly. If your bank contacts you requesting verification, respond as soon as possible. It's also important to remember that unusual doesn't automatically mean suspicious. If you're expecting a large payment from selling a house, receiving an inheritance, or completing a major business transaction, keeping clear records can make verification much easier if questions arise. The goal isn't to fear your bank. The goal is to understand how the modern financial system works. So the next time you hear someone say, "The bank closed my account for no reason," remember, there's almost always a reason. The customer may not know it. The bank may not be able to explain it in detail. Understanding that system won't guarantee you'll never experience an account review. But it will help you understand why these decisions happen and why they affect far more people than most of us realize. If you found this video helpful, consider subscribing for more deep dives into the hidden systems that shape your financial life. Because the most important stories about money are often the ones happening quietly behind the scenes.